Good day, ladies and gentlemen. Welcome to IFRS 13 on fair value measurement, a lecture presented by the CA Academy. What is important regarding this IFRS is that it's a brand new IFRS dealing with fair value measurement. Now, what you must understand right from the start is that this standard doesn't tell you what the fair value is of an asset or a liability. This standard basically tells you where to go look for the fair value, and once you've classified that fair value according to a specific hierarchy, then what the disclosure requirements would be regarding this fair value. So this is a very theoretical topic. You have to understand the new definition of fair value, what the categories are of fair value, where they fit in the levels, the three levels. That's the hierarchy that I'm talking about. Because the higher the level, if you're in level 1, you've got very good quality fair value measurements. Whereas with level 3, the quality is not so great. And as you go down from level 1 to level 3, the disclosure requirements will obviously increase. So that's why that's a bit of an incentive to go search for your fair values, obviously in level 1. Now, if we move on to slide number 4, chapter 1, and just introduce ourselves to IFRS 13, you can see there that this has been a project ongoing since 2005. The effective date of the standard, 1 January 2013. So once again, examinable, QE Part 1, also for CTA. Ladies and gentlemen, what must you remember about IFRS 13? IFRS 13 now deals with fair value measurement. Now, before the existence of IFRS 13, every standard that went into fair value measurement, if you think about financial instruments, if you think about employee benefits, if you think about the assets, all right, investment properties, how much guidance is there that's given in respect of investment properties regarding fair value? All of those guidances are removed now from the actual standards, and wherever fair value becomes an issue in a separate financial accounting standard, there's a reference to IFRS 13, so this actually is supposed to promote the consistency with which fair value is then produced or calculated for specific assets and liabilities. Now, if we look at this, we need to determine the scope of IFRS 13. Because immediately when I start thinking fair value less cost to sell or net realizable value, is that fair value? Does that now get measured under IFRS 13? Then we need to answer that question. So the scope is very important regarding IFRS 13. Now, what you must understand, if you look on slide 6, the objective of IFRS 13 is to define fair value. Ladies and gentlemen, there's a new definition of fair value, but it basically translates to more or less the same than before. New words, easier words to understand, and that's what we're going to have a look at very shortly. Also, to set out in a single IFRS, not spread out over the whole IFRS, range of standards, to set out in a single IFRS a framework for measuring fair value. And I'm saying this again, IFRS 13 does not tell you how to measure the fair value or what the fair value is going to be. They make recommendations of where you should go search for the right fair value. Which techniques should you be using? What will be appropriate? What should be disclosed? Under which circumstances are you looking at the principal market? And under which circumstances are you going to a secondary market where you're getting, the highest possible value for this asset? What do you do with non-financial assets, etc.? So that's the type of guidance that IFRS 13 is giving. So it's basically recommendations. And then lastly, you can see required disclosures about fair value measurements. And as I said, the lower the level, the higher the required disclosure. All right. IFRS 13 applies when another IFRS requires or permits fair value measurement or disclosures about fair value measurements, also fair value less cost to sell. All right, so that's very important. Right at the bottom of the slide, you can see IFRS 13 does not apply to IFRS 2. So IFRS 2 not affected by IFRS 13. Remember that. What is IFRS 2? Share-based payment transactions. Then IAS 17. When you determine the fair value of the asset that you're leasing, because IAS 17 is our standard on leases. Do you agree? So I think here specifically of IAS 17 paragraph 20, the initial measurement test. When you measure the transaction at, you're going to bring in that leased asset at fair value, or if lower, the present value of minimum lease payments, that fair value of that asset, not governed by IFRS 13. IAS 17 has its own set of requirements. And then measurements that have similarities to fair value, but that are not fair values. For example, net realizable value in inventory, IAS 2, or value in use when you determine impairment of assets and you're calculating the recoverable amount in terms of IAS 36. Those are all not covered. So remember this, value in use, not a fair value, not governed by IFRS 13, but rather by IAS 36. Net realizable value, not a fair value, but governed by IAS 2 on inventories. Okay? But the one that is affected by IFRS 13 is fair value less cost to sell in your normal impairment test and in your IFRS 5 assets, where you are specifically holding those assets with the idea of selling them, and you also work out the fair value less cost to sell. All right, so those are affected by IFRS 13. Now, in the next chapter, we're going to start looking at some key definitions like we always do in chapter 2 so that you can understand fair value a bit better. Ladies and gentlemen, in chapter 2, looking at some of the important definitions in IFRS 13, I would like you to move on to slide number 8, and that we can first look at the most obvious definition, and that is the one dealing with fair value. The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. At the measurement date. Very important, okay? What was the definition of fair value previously? And I know this is important because when we discuss things like revenue and all of those items where we talk about fair value, we often use the reference to fair value, and I know that in setting solutions, we often write the amount at which an asset can be exchanged or a liability settled between knowledgeable and willing parties in an arm's length transaction. Now, that definition of fair value will no longer bring you marks because that is now outdated. So you're going to have to make the transition to fair value. What is the definition of fair value? The price that would be received to sell an asset, that's easy to remember, the price that I receive to sell an asset, or the price that I pay to settle or transfer a liability. That's easy to remember. Now, not in an active market or in an arm's length transaction, in an orderly transaction between market participants at the measurement date. So there's nothing difficult to remember about that definition. Let's have a look at some more. What is an active market? An active market also now has a new definition, because what must you remember regarding an active market? That is the primary source for the best fair value indications. All right? So when you want to go into level 1 fair value, that means the best category of fair values that you could find. You're going to have to search in an active market. Okay. Now, an active market is a market in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis. All right, so what do you think the focus is of an ongoing market? Volume of transactions, frequency of transactions, and pricing information. All right. Now, if you look at the old definition, an active market is a market in which all the following conditions exist. The items traded in the market are homogeneous. That means similar, the same. Willing buyers and sellers can normally be found at any time, and prices are available to the public. That definition, outdated. Do not use it anymore. What's the new definition for an active market? A market in which transactions for the asset or liability take place with sufficient frequency and volume so that they can provide pricing information on an ongoing basis. Now, why do you think this volume and frequency are so important? Because the more transactions happen of a similar nature, even of an identical nature, you will see that in IFRS 13, they are distinguishing between how did you determine your fair value? Did you link it to an identical asset or liability that was recently settled or transferred, or amount that you sold the asset for? Or was it a similar asset? Now, when you move from identical to similar, you've already gone into level 2. Because level 1 relates to identical assets and liabilities, whereas level 2, the quality of your fair value measurement, is based on similar assets and liabilities. And that is why here, if you can find a market where there are many transactions relating to this asset and this liability, then you are more likely to find identical transactions, and the quality of your fair value measurement actually improves. All right, so that is the whole concept supporting the active market. If we move on to slide 10, the exit price. People, that's easy to remember. It's a new term, but it's easy to remember. The price that would be received to sell an asset or paid to transfer a liability. So what does this mean? My selling price of my asset, my settlement price of my liability, that is what they talk about when they talk about the exit price. Okay. Now, the next term that we need to look at a definition for is highest and best use. All right? Highest and best use. Now, what's important here? This is applicable to non-financial assets. Now, ladies and gentlemen, I think we need to go just have a look at the difference between financial assets and non-financial assets. Okay? A financial asset is an asset that will be settled in cash or cash equivalents. So if I look at cash, cash is already cash, so it's definitely a financial asset. If I look at receivables, then that's a financial asset, because how will the receivable be settled? In cash or cash equivalents. All right. If I look at inventory, many people think, well, I'm selling inventory only for cash, so I'm going to be receiving cash or cash equivalents. People, that's not right, because what must you remember? In between inventory and you getting cash, there's still a transaction that must happen. So that inventory is going to get sold and replaced by a receivable or cash. And that's when the financial asset arises. So inventory is a non-financial asset, despite the fact that it's going to be sold one day, maybe for cash or cash equivalents. The sale has not yet been concluded. Do you see the difference? So in order for you to determine financial assets versus non-financial assets, you're going to have to ask yourself, is there an unconditional right to receive cash or cash equivalents? And if that is so, that's a financial asset. Think about a debtor. The sale has taken place. The customer has taken delivery of the inventory. The amount is legally owed. It is enforceable in a court of law. There's an unconditional right to receive cash or cash equivalents from the debtor. Therefore, the debtor is a financial asset. You with me? So that's the difference. Now, some examples of non-financial assets could be inventory, property, plant and equipment, intangible assets. All right? So those are the items that we are looking for when we're talking about non-financial assets. Now, what is IFRS 13 trying to say about non-financial assets? Highest and best use. The use of a non-financial asset by market participants that would maximize the value of the asset or the group of assets and liabilities within which the asset would be used. So we can see already from this definition that when it gets to the fair value of a non-financial asset, that's more difficult to determine. Do you agree? And what are we going to do? We're going to give the benefit of the doubt to this non-financial asset by determining the fair value with reference to the highest and best use. Very important. Okay? So that means when it gets to a non-financial asset, fair value measurement is more difficult. And then what are we going to say? If I look at this non-financial asset, what will be the highest and best use for this asset? And that is the way that I determine the fair value.